Aman joins us, represents Abakkus Asset Management. Aman, good morning. Thank you for joining us. कहाँ थे भाई, बड़े लेट हो गए?
On the way.
Bombay traffic.
Bombay traffic as always.
But I think the new infrastructure is quite interesting. That means you started late. It's okay, you started late.
Part of the daily routine now.
Yes. What's keeping you busy as a fund manager right now? Are you looking at bargains? Have you started investing? What is that whole big market thought which you right now have after this bout of volatility?
Frankly, Nikunj, there are no big bargains in the market. It's a fairly priced market. It's definitely not a cheap market. We all know that. I need not say that. But at the same time, it is not like too expensive that one needs to be too worried and it's like a runaway kind of a thing. It's a fairly priced market, and hence in this you get fair price ideas. You get fair price ideas. There is no bargain per se. There could be few, say 1 out of 20, 1 out of 30, something like that. In the current volatility, we feel, as you were saying, we feel in the near term, there are no immediate triggers for the market to move substantially. So it's going to linger around based on how the news flow develops, how Trump reacts, how China reacts to what Trump does. So it's going to be completely news flow driven markets. And I think we'll start facing the same period where Indian markets blindly follow the global clues. If overnight US is up or down, next day morning we'll have a gap up or gap down. I think we are headed towards that kind of a scenario, at least in the next month or so.
Where are you picking your spots in this market? Are you picking any themes? For example, there's a time when you started buying a lot of railway stocks. There's a time you started buying a lot of mid-cap banks. Are you picking any individual themes here?
So, large private banks is something that we are increasing our exposure. We are increasing our exposure to metals. We feel the Chinese policy is positive overall for metal prices. We are still neutral on IT, but on the fringe, we have started looking at it. I believe we would increase some of the exposure there. And besides that, pharma and chemical, these are the two sectors where we are definitely increasing our exposure. So these would be the, you can say, buckets where we are like currently focused on.
Have you started planning your portfolio positioning because of Trump 2.0, higher tariffs, more tariffs against China, less against India? So when you say chemicals and when you say metals, are they centered around this entire Trump 2.0 policies?
Metal was prior to Trump when the Chinese had their own, you can say, fiscal stimulus coming in. Chemicals is a broad call. Prices are close to bottoming out. They have been on a downward spiral for more than a year now, and things seems to be stabilizing now. The reason we have not yet gone ahead and done it because we also don't know in the near term what would Trump will do and how China will respond, because that will have an impact on currency. So if dollar was to appreciate and INR was to depreciate, then if yuan also depreciates, then it's lots of interconnected play on the currency front. That is the reason we are looking around at it. For chemicals, we have not yet acted.
Morning, Aman. Wanted to get in your take then on the entire infrastructure space. Given the fact that now a lot of analysts are talking about the focus on execution post the BJP win, what is your outlook as to what this could spell out for the sector as a whole and what it could mean in terms of execution, orders picking up, and momentum growing in the space?
So we are very positive on this sector, even prior to the election and even now. Obviously, elections are the only state specific, but pan India, we expect government spending to pick up. Government is aware that on the fringe, demand has not picked up. In the first half of the current year, any corporate you would have spoken to, they would have all said that second half is going to be better, things will pick up. Diwali this year is going to be good, post that there is going to be a marriage season. So far, it is not picked up the way one would have expected, and hence the government is aware of this. I believe in the next, or maybe they have already started, there is going to be a higher focus on government spending, and that's anyway positive for the whole sector. And more on so the EPC companies, the infra companies, they all trade between 15, 17, 18 times forward 26 earning, which in this market on a relative basis is still something which is attractive rather than paying a 40, 50p somewhere else where demand is slowing down. So from that perspective, it still makes sense to look at this sector.
Aman, IT is growing at 5-7%, but the AI push has kicked in. Do you think somewhere the rate of growth could pleasantly surprise us now, because these businesses have stopped contracting and now AI has kicked in?
Will depend on how the tech spending in US happens. If there's going to be a corporate rate cut in US, the corporate there will have more cash with them to spend on the IT and IT upgrades, and that indirectly will mean that Indian companies could have more business to cater to, and hence the growth rates will definitely pick up. So it's subject to the IT spending there. AI, I don't think will materially impact positively or negatively Indian companies, because the work we do is not much AI dependent. And if one has to spend more on AIT, or you have to be relevant, or you have to spend and make your company compatible with an AI, then the incremental spend is also not that huge to materially impact the growth rate of the Indian IT sector, because this sector is now huge. For a few mid cap or small cap IT companies, it can be a meaningful revenue driver, but overall, it's not something that is going to move the needle.
Aman, as a house, you've always had a tilt towards small cap stocks and mid cap stocks, not so much so towards mega cap stocks. Are you consciously looking at mega and large cap stocks now, because that is where the store of value is?
Frankly, Nikunj, last 6-8 months, this has been the consensus call for most strategies, which is mean reversion. That last 12 months, mid cap and small caps have done well, so now large caps will do well, and it's like a kind of a mean reversion. At Abakkus, we never have this discussion of large cap versus mid caps or small caps. For us, at any given point of time, try to pick stocks where there is value, where there is some news, where there is some positive development, where there is investment rationale within large cap and within mid cap. So today, sitting here, I'm looking for something interesting in mid caps also, in large cap also, and that would be the case 6 months back. That will be the case 6 months later also. So for us, it's never a large cap versus mid caps. We stay true to the strategy of the fund. If a fund has large caps and mid caps, I would be buying both of them. I will never have said, okay, now today I have a 90% large cap. After 6 months, I'll move the large cap to small caps.
And take us through the diversified alpha approach that you guys have in terms of which sectors are looking promising and why.
Diversified Alpha approach is a 40 stock portfolio that we have that invests across the 4 buckets of the market, which is large, mid, small, and micro. As we speak, almost 25-30% would be financials. In the last 6 months, we have also increased our non-fund based financial exposure. So we added a wealth company, we added broking companies. So besides banking and NBFCs, and non-fund based financials is something that we have looked around. As I mentioned, metals is something which is there, which we say high single digit exposure. Tech would be mid single digit. Industrials and engineering, EPC companies all put together will be another 15-20%, and consumers will be around 10%. So in that sense, it's a fairly balanced portfolio. We don't have an auto exposure. We don't have FMCG because of valuation concerns. And right now, that's broadly what the portfolio is positioned.
I always look at the IPOs to indicate where excitement and where there is euphoria. And one theme which in a sense has become a very prominent theme suddenly is energy transition. Some are buying wire companies, some are buying solar companies, some are buying meter companies. What is your view on this great energy transition theme? And then I have another follow-up question, which is, what do you make of this entire solar space where suddenly a lot of companies have gone public?
So definitely, there is going to be an energy transition the way we are seeing in auto, where EV is going to be the mainstream. Similarly, for energy, also renewables is what the future ahead is. Even right now, most of the utility companies, the incremental spend which they're doing to add new capacity is more towards renewables than the traditional coal-based power plants. And hence, for investors also, this is where there's going to be a natural swing. Since we already had lots of listed utility companies and solar companies are not there, and now they're coming up, obviously there is a buzz, there is euphoria, there is too much of supply as well as demand for this sector. And this sector is going to stay. The way solar module prices have crashed, it makes economic sense without subsidy also to have a solar plant. And the way lithium prices are also corrected, very soon we will have also a very viable storage option for the solar cells, and hence the issue that solar is not 24/7 can also get addressed. Maybe not in the next 1 or 2 years, but definitely for the next say 5-6 years, we might have something which is sustainable and which is possible. So this is going to stay. Solar will soon become, if not mainstream, but at least bulk of the incremental spending will go towards solar company, and that bodes well for these companies. So cell makers, module makers, EPC companies will install solar panels. They all will see increased demand. They all see good times ahead, and that's where I believe the market euphoria is right now.
So to wrap it up with one follow-up question on that. So then what is the best spot according to you to really invest in? Should one buy an existing power utility company? Let's say I'm using Tata Power for reference for our viewers here because they were in thermal, they are moving into solar. Should one buy into Adani Green because it is a promise of clean fuel? Should one buy into a wire company which has a promise of transporting wire or transporting electricity, or should one buy a solar company which has a promise of giving cheap power?
We are currently buying more of solar EPC companies because whoever does what, these companies will see good demand, will see good growth prospects going ahead. Along with that, we also have the ancillary companies. So we already have a wire company in our portfolio, but it was not linked to a solar. But obviously, they will also benefit the way the solar spending will happen and the way the T&D spending will happen. So we also have T&D EPC companies because unlike a power plant where you need just one transmission line from the power plant to the grid, for solar, you need to have completely new set of wirings and completely new set of transmission equipments to come in. So these companies also are a natural beneficiary of the higher spend going into renewables. So these two are our current focus. We have not taken big positions, but we also invested into direct solar EPC, besides EPC companies, the solar plant owners or the utility companies into renewable space. So some small exposure that we have taken. It's also a function of what valuations. The company that recently got listed in the IPO, which makes solar modules, we find the current valuations too steep to incrementally put money. You would have invested in the IPO, but now the price is more than 2x of the IPO. So at this level, not incremental money going to that name. But that space also, it's also a function of valuations. If it has to correct or we get a good decent value, why not?
All right. Thank you so much for taking time out and joining in. Appreciate your take on the markets.
If you like this video, then like, share and subscribe to ET Now.